Good evening. On behalf of the Student Academy of Doctors of Audiology, I would like to welcome you to today's Student Practice Management webinar on accounting, bookkeeping, and embezzlement. My name is Stephanie Chayeski, and I am pleased to serve as today's course coordinator. I have just a few housekeeping reminders before we begin. First, if you have any technical challenges during the session, please use the chat feature to make me aware, and I will be glad to assist you. Please type your questions into the question queue, and they will be addressed by the presenter at the end of the presentation. Today's presentation is being recorded and will be available for online viewing next week. At this time, it is my pleasure to introduce the course moderator for this session, Glenn Elms, the current SATA membership chair and fourth-year student at Salus University. Glenn?
Thank you, Stephanie. On behalf of the SATA board, I'm excited for the opportunity to welcome AUD students from programs across the country to this session on managerial accounting, bookkeeping, and embezzlement. It's also my distinct pleasure to introduce today's course leader, Giovanni Hugart. Dr. Hugart is an experienced private practice audiologist who's owned several offices in the Atlanta area. She was co-owner of Hearing Doctors of Georgia for 35 years and has recently retired from this practice. She is currently consulting for an ENT practice in Atlanta, performing diagnostic testing and hearing aid selection, fitting, and rehabilitation. She is co-owner of Georgia Equilibrium Diagnostics, an educational and consulting practice for vestibular testing and treatment of vestibular imbalance disorders. She is an adjunct professor at Salus University, teaching audiology practice management and cerumen management. She is also an affiliate professor at Auburn University, where she teaches private practice audiology and professional issues. Dr. Hugart serves on the governor-appointed Commission of Deaf and Hard of Hearing Persons in Georgia. And I'll turn it over to Dr. Hugart.
Thank you so much. I appreciate your introduction, Glenn. Thank you for having me. Today's lecture is about accounting, bookkeeping, and embezzlement. Accounting can be rather dry as well as bookkeeping, but it is such an important skill to at least be introduced to and understand somewhat, especially with you going into private practice, or if you are going into any kind of practice, you need to understand accounting, since financial aspects of a business are critical in continuing that practice and allowing it to thrive. It's important for you as an employee to know what these different terms are, how the practice is being run financially. You don't necessarily need to know the incidentals, but an overview and just some understanding is helpful. If you're considering going into private practice, yes, you'll probably have an accountant. However, it's important to know your books, to understand what you might be looking for in case there are issues within a practice or your practice that you are concerned about financially. And you should know how to read your books and understand what they mean. So I'm going to go over some things. I'm going to talk a little bit about, let's see here, learning objectives. Let me move this out a little ways. I want you to be able to identify basic accounting principles for audiology practices. And that means just what the fundamentals are of accounting for a private practice, or even just a regular practice, whether it be at a hospital or an ENT setting. I want you to be able to define accounting and bookkeeping terminology. This you will see very often in your different financial statements that you may review or look at, literature that you may read about practice management, finances within practice management. I'd like you to be able to understand and identify primary financial statements. That may be extremely helpful in an audiology practice. all statements that are readily available and you should be able to at least identify them and understand their relationships. And finally, define internal controls to prevent mishandling of funds, i.e. embezzlement. It's so important to have, I would say, internal controls within your practice so that you can prevent, or if embezzlement does occur, you can identify it readily and quickly so it's not too late. And we'll talk more about that, and I'll give you some examples of situations that I have actually been in contact with that people have embezzled or mishandled funds. And we were able to determine actually who the person was and identify that person, as well as, more importantly, identify there was a problem before we lost too much money. Okay, so let's start from the beginning. Let's talk about accounting. There's two different types of accounting methods that I'm going to discuss. And the first one is cash accounting. And this is where we recognize revenue and expenses only when money change hands. This is the simplest type of accounting system. And that is basically you are seeing the cash that comes in and you know the expenses that you distribute. Most private practices use this type of accounting system because it's easy. It's pretty straightforward. It's simple to maintain. You can see the transactions readily, and it's easy to keep track of the revenues that are coming in and going out. You can look at the bank balance and understand exactly how much money is at your disposal. So it's pretty easy and straightforward, and cash accounting is used most of the time with private practices, I would have to say. Accrual accounting is a little different. Accrual accounting is more like you recognize revenues when it's earned at the time and when expenses are billed but not paid. So an example would be you have just finished a project and it's been completed and you are supposed to be paid a certain amount of money. That is what is actually recorded in your books, what you are owed at the time when you complete the project. Okay, it gives you an idea of what kind of income and expenses are going to be coming in and going out during that period of time. The only problem about accrual accounting is that you don't know how much money you actually have in your account. So your business may look like it's very profitable because you have this money that's coming to you because you've completed X amount of projects. However, if you hadn't been paid that money, you don't have it in your bank. So it can be pretty devastating in a sense because it's kind of a fictitious kind of money that's coming in. This is helpful a lot of times if you are somebody that utilizes a lot of inventory in your practice. So you get an idea of how much may be going out. And it's not necessarily the cash that's there, but it's a promised type of money that you may see down the road. So if you're going to choose between the two, and you're not very sophisticated in accounting, typically a cash basis type system is easy to use. The second thing, when you're setting up your bookkeeping, there is a thing called chart of accounts. Now, most of us who have owned a practice, we have retained a accountant to help us with our books, help us set up our accounting or our chart of accounts. And what that is like a ledger. It's a breakdown of your financial transactions. And I've given you an example in this slide of how a chart of accounts would look. For example, I use an accounting system called QuickBooks. You may have heard of it. It's one of many different types of of systems that you can use, and depending on who your accountant is, they will advise you on the type of accounting system you may want to set up in your practice, or that is set up in a practice that you're working in. The accountant will set up a chart of accounts that will numerically identify the different account types that you have designated within your practice. In this slide, I have given you some examples. If you look at the numeric section, I have numeric numbers of 300 to 399, 400 to 499, 500 to 599. Under each of the numeric areas, we have the account type. So for example, if you have purchased X amount of hearing aids, okay, that's considered a cost of good. That typically will be under a certain numeric number. So it could be designated, your accountant may have designated hearing aid cost of goods as 350. And so that is automatically put in when you put hearing or cost of goods. If you generate that into your QuickBooks, automatically a numeric number will pop up that's designated to that category. The reason why you have these categories are for the financial report, which is the third line on this slide, and it is for the different types of statements that you will generate at certain times of the year, depending on what you want to look at. But these type of statements, well, we're going to talk about them, give you different information about your practice. So basically, those financial reports have the numeric and account type designated for the purpose of the different financial reports. So it's very useful. It's very logical in the way it's set up, and your accountant will typically do that. Now, I've given you on the bottom half of this slide several types of different accounting software that is available to do the type of things that we're talking about, bookkeeping and your general ledger. As I mentioned, QuickBooks is a very, very common one that's used, and it's a very easy type of system. And that's the one I'm most familiar with. That, and there was also Quicken at one point. I used that, but I converted over to QuickBooks. You also may be introduced to other kind of software like Xero, FreshBooks, Sage, and these are just a couple. There's a lot of them out there, depending on your accountant. But I would assume that they are all going to have some chart of accounts, because it helps with breaking down what your different account types or categories that you're using in your practice, that you're bringing in money as well as expending. And it helps with the financial report that at the end of a quarter or end of a fiscal year, you would be utilizing. So when I talk about a quarter, I might as well define that for you. There are 4 quarters in the year, and it starts January, February, March is first quarter, April, May, June, second quarter, July, August, September is third quarter, and then finally October, November, and December is your fourth quarter. Depending on how much you want to identify what is actually occurring within your practice, that determines what your time period is that you will reflect on to understand what financially is occurring. So many times people will do a quarterly report where they will generate 3 different financial reports, and you are able to look at those reports at that time period and cross-section them, and you're going to learn about the different reports in this webinar, but you are able to cross-section them, and it gives you different kind of information regarding your practice. Now, fiscal year is different than a quarter, and depending on your business and when you want to start that fiscal year, it is It can be anywhere from September to August. It can be from January to December. It can be from July to June. It just depends on your organization and how you want to dictate the fiscal year. The only rule of thumb when you're talking about fiscal year is that you never start a fiscal year in December. That's a rule of thumb. But a fiscal year is different than a quarter. And you may decide you'd rather start a fiscal year and use that as your point of reference or time period for reviewing your financial reports. So that is the purpose of chart of accounts. It's looking at different type of accounts, giving a numeric value to that so that it can be used for your different financial reports. And those financial reports are analyzed at different times of the year, depending on what you want as far as time period and what you're looking for in that time period. And these are the different kind of software, accounting software that you may be looking into for your practice, and you would probably want to get with your accountant to determine what's the best software for you and for your accountant to use and communicate with. Okay, so the next thing I want to talk to you about is the type of bookkeeping that practices use. There are two types. There's a single entry bookkeeping, and then there's double entry bookkeeping. Single entry bookkeeping would be a one entry type of thing. I guess I would compare it to like your checkbook, or if you keep a ledger in your computer with how much you spend, how much you bring in. That is single entry. You're only putting it in at one line. You're not really doing more than one transaction at a time. The problem with a single entry is it's difficult to track information. It's difficult to track if you have inventory. It's difficult if you have accounts payable, different accounts that you owe money to. That's what accounts payable are. It's difficult to have an idea of what your accounts receivable are. Accounts receivable are what is owed to you. So single entry is a very simplistic type of bookkeeping that is not typically used in a practice or in a business. There's other reasons too, and we're going to talk about that when we discuss double entry bookkeeping. Most small businesses use double entry bookkeeping, and the important getaway with double entry is that you're basically trying to keep an eye on transactions and ensuring that there is a balance to those transactions. And that means there is a debit and a credit. When something is purchased, there's a debit and a credit so that you have two transactions that are actually occurring, even though it's one. I mean, if you think about it, technically there's one transaction, but on your books, we're showing two. We're showing you buying, okay, and we're also showing you paying. So that's where your debits and your credits come in. Your debits and credits are also seen in different financial statements, like a balance sheet statement. That's where you are going to use a debit and a credit so that you can see there's a balance going on here. There's a transaction that occurred and there's two things that occurred at that moment so that they cancel each other out basically. And you have some way of tracking your transaction. And this is extremely important when you're talking about handling money, because you need to know where the money went and what the transaction was, where you spent and where it went to. And that's where the double entry bookkeeping comes into play. I gave an example here, and I'll just read it for you. A practice pays a hearing aid manufacturer. The cash account would be reduced by the amount the practice owes the creditor, and that's the debit. Then the double entry reduces the amount to the creditor account as it has received the amount of the credit of the business. This is the credit. So you see there's one transaction, but there's two ways of viewing that transaction, and it's more for checks and balances. So double entry is extremely powerful, and there's a lot of information that's being done, more for you to follow what's being done as far as transactions go. So let's go on and talk about financial accounting, and let's talk about the three core type of financial statements that you would be looking at as a practice owner. You have balance sheet, income statement, and cash flow statement. They each have very important information, but they have also different information. And together, or I should say all three, provide a very clear picture of what your practice is doing and helps you analyze if there are some things that aren't occurring that should occur, or maybe if you're profitable and you didn't realize how profitable you were. It tells you all kinds of things that we're going to go over. But it's important to understand that, and I can't emphasize this enough, when you're looking at these different financial accounting statements, that you are looking at a time period, and you can't look at, for example, balance sheet in the first quarter and compare it to the income statement of the second quarter and looking at the cash flow for the entire year. That's not going to help. It's very confusing, and it's not going to give you true information. However, when you take a certain period of time, like say you decide you want to look at your first quarter because you feel like this first quarter, which would be January, February, March, was a really profitable. You sold a lot of hearing aids, or you did a lot of tests, or this was a very profitable time, and you have a sense that you did very well. And maybe I need to look at it. Why did I do so well? Did I spend more money with my marketing? This is where you can look at your balance sheet, your income statement, and your cash flow statement, and that can provide you with an idea of how well you did for that particular time period. So that the thing I want to emphasize here is that it's so important to compare these things at exact time periods for each of them. Let's talk about the balance sheet first. This seems to be one of the more confusing areas for people, at least when I teach this class. And so I'm going to hit on this and take it slow. I always say that the balance sheet is a snapshot of what the financial position of a practice is at a certain time period. It tells what your business owes and owns. It also tells what the owners have invested. The balance sheet's important because it tells you how much money you have that's available for that time period readily. And it also tells about what your assets, how they may have generated revenue. It also gives an idea of what your debts are as compared to what your equities are, how much money you've invested in it. It gives you some form of financial risk. Why do we need a balance sheet? Well, we need a balance sheet because if you're using double entry, your debits and credits are being seen on the balance sheet. Now, people get debits and credits confused, and it's because of the wording. So I want you to kind of blank out your brain and don't think of debits and credits like you would typically think of it, okay? Like a plus and a minus, okay? Don't think of it like that. I want you to think of it in terms of right and left in your balance statement, which I have right in front of you. Your debits will not be your assets. Will be your assets. The debits will be on your left side of that balance sheet, and your credits are going to be on the right side. Okay? And that's how you have to look at it. If you look at it purely by the word and what you think that definition is, I will promise you will mix it up and put the credits on the asset side and the debits on the liability side. That's not the way it works. You have to look at it as it relates to your double entry booking and the example that I gave you previously. So if you look at this balance sheet and I say, okay, so where's your debits? You would say the debits are on the left side of that balance sheet where the assets are, the credits are on the right side. Now, the other thing I want you to be very much aware of is that when I identify assets, what am I looking at? Okay, I'm taking it for granted you know what an asset is, and you may not. So let's look at the asset column. The assets in this case would be money that you have in the bank, money that you might have in your drawer for petty cash. It may be temporary investments, accounts receivable. Remember what accounts receivable are. Accounts receivable is what people owe you. Your inventory is considered an asset. Insurance that has been prepaid, money that you've paid forward. If you have any investments, any kind of equipment or property, that's considered part of an asset. If you own a building or you have depreciation, that's considered part of an asset. It's an income. In this particular balance sheet, you have a thing called intangible assets. Well, intangible assets mean that it's not something that you can touch so much. It's something that maybe you've built, like a reputation. That's where goodwill comes in. Sometimes, well, not so much now, but in the past, practices have been evaluated by a goodwill, meaning how much, how many charts they have, how many, what their reputation is in the community, their market share in the community. That is considered a goodwill, a trade name. These are things that really, quite honestly, are very difficult to put value to. That's why they don't really use that. They don't use the equation of goodwill much anymore when you're evaluating and putting valuation on a practice. So goodwill is something that can be used, I guess, as a leverage. But anyways, I just want to make sure you understand that. If you look at the bottom, you see your total assets when adding all this out and subtracting out things come out to $770,000 in this particular balance sheet. If we look on the side of the liabilities or the credit side, these are things that you may owe, okay, like notes payable. You may owe money there to another entity. It may be a little loan that you've taken out. I'm just throwing that out there. Accounts payable would be like your bills that you owe, like if you owed money to hearing aid manufacturer, or if you owed money for supplies, that would be accounts payable. Wages, like salary, if you owed people money for that. Taxes, any kind of warranties that you may have to pay for. These are all liabilities. Long-term liabilities would be maybe like a loan that you've taken out for equipment or something like that, or a building. And this is broken down into notes payable or bonds that you have to pay. And then finally, we have the stockholders' equity. Lots of times when we start a business, most of us don't have a whole lot of equity that we have available, but you may have sunk in money to that business. And that's where it breaks down into, it becomes a little more financially involved when you're talking about stocks and retained earnings and things like that. But that's part of what the equity of what the owner has invested in the company. And as you see, the big thing with the balance sheet is 770,000 is on your assets and 770,000 is on your liabilities. So that's what you have to be sure of when you're doing a balance sheet. And this is where people get really, there's problems with doing balance sheets because they don't know how to do them. But when your accountant does it, he will ensure that you have a balance on both sides. This is where your double entry bookkeeping comes in to ensure that it's balanced and that we see where all the transactions are coming from. Okay. Again, this is easy. It's a snapshot. It tells me, okay, well, okay, when I look at my assets, I see it can break them down. My total current assets are $89,000. My total liabilities are $61,000. Oh, wow, my liabilities are $481,000, and over here, my property's $337,000. And then we're starting to break down the assets here. And when we start looking at this versus this side, we know that we have to look at our stockholders' equity in order to ensure that our liabilities balance with our assets. So we may have to take money from our stockholders' equity, or we may have to use that as partly helping with ensuring that we have balance with on both sides. So this is a very, very quick and overview of what your company might be doing. The next statement that's extremely important is profit and loss statement, or it's also called income statement. And when you look at a profit and loss statement, it's divided into sections, and basically you're looking at profitability of your business. You want to see how profitable it is for that time period that you've designated. So you're going to use the same time period you used with your balance sheet because you're getting an overview, a snapshot. Now we're trying to find out different information. We're trying to find out what profitability is. And basically your profit and loss statement looks at revenues, your costs for that given period, fiscal year or quarter. It's a company's ability or inability to generate profit. It gives you an idea, did I have a profitable quarter, or did I have a profitable fiscal year? It helps you also with looking at, if you compare it to historical reference, to see if potentially one quarter might be a really profitable quarter, the next quarter may not be. Why is that? Last year it was the same way. What's the bridge that or the key to making that quarter such a profitable quarter? It gives you the information for profitability. I'll show you an example of it, and this is an example. I didn't fill it in or anything. It's just to show you. But you have your income typically on the top, and then you have your expenses broken down here. So it's different than the balance sheet because we're not really looking at specific transactions, but we are looking at an overview. But for the profit and loss, we're breaking it down even further. We're really trying to find out, okay, how much money am I bringing in for this time period, and how much money am I expending, and am I making any money at the end of this quarter after I've spent all this, spent all the expenses, looking at my total income? What am I making, or as far as profit goes? And it gives you maybe some idea by looking at it where you're spending a lot more money. It's not exact, but it gives you an overview of that. But chiefly, the profit and loss statement is for pure profitability purposes. Finally, the cash flow statement. Cash flow statements are even more detailed than the profit and loss, as well as your balance sheet. So if you haven't noticed, as we go down the line from balance sheet to profitability, now we're looking at cash flow, it becomes a lot more detailed. So You're looking at inflows and outflows of money that's coming and going out of your practice. The P&L or the income statement is not as detailed, and you're able to see payments you receive in business expenses and cash flow. It's a little bit more detailed, and you can really get a feel for what you're paying and what's going out and what's going in specifically. You get a better idea day to day of what's your day-to-day money coming in and out looks like. This is extremely helpful when we get to embezzlement, to have this statement, because you really know you can match up things better. You can find out if your bank statements and your cash flow statements are coming out and they're equal. Because if they're not, there could be something that's not right that's going on in your practice. So cash flow statements are very, very detailed, and it gives you a little bit better idea of what's going on. And I just kind of gave you an overview of one, so you can see the net cash flow from operations and investing activities. It's a breakdown of all the different areas, like your financial activities that you have, and you can see it's broken down into 3 different areas in this particular cash flow statement. So it's more detailed and gives you more information about what's going in and out of your practice as far as money goes. Okay, so I have a little YouTube here, and just to summarize what all 3 of these statements do, and hopefully we'll pull it all together for you.
If you manage a team, you should be using Monday.com. It's a platform to manage any team and any project.
Today we'll talk about the cash flow statement. It's one of the 3 main financial statements, but often overlooked. Sure, the income statement provides information on revenue and profits over a certain period of time, and the balance sheet gives a snapshot of the financial health at a certain point in time. But it's the cash flow statement where you can find out how effective a business is in managing its cash and what it spends it on. And in the end, cash is the lifeblood of any business. If you can't pay your employees, your vendors, or your taxes anymore, it's game over. So let's get started. In a previous video, we talked about the difference between cash and accrual accounting. We said it's important to understand that profits and cash can be 2 different things. Profit is defined as revenue minus expenses. And in accrual accounting, we report revenue when it's earned and expenses when they are incurred. But earning revenue doesn't always increase cash immediately, and incurring expenses doesn't always decrease cash right away. Remember this important difference to cash accounting. If you want to find out how much cash a business has, you could just look in the balance sheet. There, you're going to be able to see if the cash position has gone up or down. But this way, you won't see how the cash came into the business, and maybe even more importantly, what it was spent on. Therefore, to get a complete picture of the business, we also need to look at its cash flow statement. Just think of this as a report that shows you how cash was entering or leaving the business. If you see a positive figure, it means cash came into the company. A negative figure means cash left the business. A cash flow statement looks like this. It consists of 3 main parts. The first one is the cash flow from operations. This is the most important part because it shows you how much cash is generated with the actual operations of the business, meaning by selling the company's products and services. Then we have the cash flow from investing activities. As the name says, this is either cash spent on investments or cash received from sales of investments. In other words, it's outside of the primary business activities of selling products and services. In this section, we can see if the company purchased assets like machinery and equipment, or maybe even acquired another business. Last one is the cash flow from financing activities. This section summarizes cash transactions that involve raising, borrowing, and repaying capital. For instance, here we can see if the company issued new shares, if dividends were paid, if a bank loan was taken out, or if a debt principal was repaid. At the very bottom of the statement, you see the reconciliation to the balance sheet. It shows you the starting point of cash from the last period and the ending balance from the current balance sheet. The difference between the two is the net change of cash, which has to equal the sum of the three cash flow sections above. In other words, beginning balance of cash plus the cash flows from operations, investing, and financing must equal the ending balance from the current balance sheet. Let's look at the three main sections in a
Okay, let me see, where am I here? Oop. Did I lose it? Did I lose you guys? I'm trying to get back to where I was.
Dr. Hugart, it's Stephanie.
Yeah,
I think you may just need to reopen the
um,
PowerPoint or click on the.
well, I'm sorry about that.
That's okay.
Messed me.
Nope,
Oh,
you're good.
hey,
Yeah,
yay! All right,
yeah.
thank you, thank you. Glad you're here. Yeah, I just wanted you guys to get an overview of it, and I'm hoping that helped you understand at least the how that they become very important in their own right with the balance sheet, the cash flow, and then you have your profitability, which is the P&L. But it helps you understand when you have to sit down with your accountant, at least you get an idea, and between those three, you'll see how your business is functioning. Okay, so the last part of my lecture here tonight is about embezzlement. And I did some research and I came upon a really interesting study that is done typically every year or every other year by a company called Hiscox. And it's an insurance company. And basically, this company insures businesses for embezzlement issues. And they do a study, I think, of almost every year. And typically, what they'll do is they'll pull up an embezzlement case for that year and delve into it and present the findings from that particular embezzlement case. But in 2018, they did it a little differently. They used Wakefield Research and performed a study, and they sent out surveys to accountants and controllers of different businesses to get who their job basically is to prevent this embezzlement for small businesses and businesses in general. That's their job, to prevent it. And so they received information from these sources and came up with some very interesting statistics and percentages and stuff. And I thought I'd share it with you. Before we start on their findings, I just wanted to mention that in my career, I have seen embezzlement on several different levels. My colleagues have, some of my colleagues have unfortunately experienced embezzlement in their practices. I have had that happen to me on two different occasions, and luckily, in both scenarios, I didn't lose a tremendous amount of money. I was able to determine who was mishandling funds in my organization, and I didn't lose a lot of money. But I had a colleague who actually lost like $50,000 because she trusted one of her employees who she knew for years, and this particular person ended up instead of paying the practice taxes, which she was in charge of the bookkeeping, she ended up taking the money and and pocketing it. And so the only reason my friend found out about it was the IRS contacted her about not paying her taxes. And this person was like a family member to her. So anyways, that was one of the situations that I knew of. Oh, another time was a doctor's practice. It was a pediatrician that I worked with. He and his partner lost $100,000 from someone in their practice that embezzled money that, again, it was someone that was managing their money, and it was mishandled, money that they never did get back. So many times the common denominator is that it's somebody you really never would expect, somebody you trust. And that's why it's important to have bookkeeping and internal controls within your practice to let you know when things like this may be occurring. I was always very funny. I like finance. It's something I've always gravitated to more than marketing. And I always did my own books. And I have an accountant, of course, but the day-to-day stuff, I always was very much involved in it, and I didn't let anybody else really do that. I usually oversaw the bills. I had a bookkeeper, but I managed to always sit down and I signed off on the checks. So it was more because I like working with finance, but there are people that really, practices that really don't enjoy that. They like marketing, or they like doing other things in their practice, and that's more of a pain for them. And so they enable other people to do it, and that's okay, as long as you have ways of being able to cross-section and determine if there's a potential for you possibly being embezzled. Some of the statistics that Hescock shared were, I have them here in front of you, 79% of the time there was more than one perpetrator. I would have to say in my situation, and in the ones that I know about in other practices, it usually was just one person. It wasn't more than one. 85% of the cases were perpetrated by someone at a managerial level. I would have to say that in fact is true in the cases that I know of. 70% of cases lasted more than a year. In my situation, 6 months. In other situations, obviously, it was more like 5 years, and again, here's 31% of the crimes went on for 3 years or longer, and 33% of perpetrators work in the accounting or finance department, which makes sense, right? And they gave some warning signs, and I don't know how much of this is profiling or what, but one of the things that these are some of the characteristics: intelligent and curious, extravagant with money, are risk takers, diligent and ambitious, maybe a disgruntled employee. For my scenarios and the people that I know of who were embezzled, usually these were people were trusted, that they knew very well, that were considered, because it was a small business, small practice, like part of the family. And typically they were people that were desperate. They had situations that occurred in their lives that maybe typically they would never think to do something like this, or they didn't do it for many years. And all of a sudden they were pushed into a corner, and there was they were desperate to do it. And that's the scenarios that I came up with for my practice. But I guess these are what Hiscock look at as warning signs. Keep an eye on. And I would have to say greed and opportunity were definitely some of the reasons that they would do, they would consider doing some embezzling. Excuse me one second. I think when you're looking at hiring, most embezzlers, they don't start out at that level. They don't intend on coming in, and and embezzling when they're hired. But I think after a while, familiarity can sometimes breed possibilities of taking advantage of employers, um, just like anything else. On the average, an embezzler has usually been working for a company, and they've worked for the company for at least 8 years, according to Hiscox. Motive: an embezzler may steal for the first time because they have a financial crisis, like I mentioned. They're pushed into a corner, and desperate people do desperate things, I guess. Often, in encouragement, often the embezzler is surprised at how easy it might be to steal something. They may try it out. Maybe they're in the front office and somebody comes in and pays cash for something, and instead of documenting it, writing a batch or putting in the computer, as a sale and payment transaction, they pocket the money and nobody really noticed and they got away with it. Exposure: after a year or two of stealing relatively small amounts on a regular basis, apparently there's a pattern that the embezzler gets caught, and perhaps one of the co-conspirators leaves for another job. This is sometimes, I guess, the pattern. And then finally, a punishment. The embezzlers may simply be fired, free to prey upon others. So a lot of times there isn't any legal action that occurs. I know in my scenario there really wasn't. We ended up letting the person go. I guess the one where the lady took a tremendous amount of money, I'm not sure if she ended up going to jail or not. So I guess typically people that embezzle maybe get away with it a lot of times. They're not necessarily prosecuted. So how is it done? What areas are usually kind of open? Well, billing fraud, I gave you a good example about somebody just coming through, especially in our business. We have a lot of cash business. Petty cash, in my situation, it was petty cash that was being stolen, and was being replenished, and a little bit was taken out. Theft and larceny of property sometimes. Sometimes people if they're given the opportunity to be able to sign or write checks, they may write themselves out a check and not record the transaction if they're given that power. If they have any kind of ability to deposit money, if they're in charge of payroll, skimming, cash larceny. These are the different methods, and then here are the percentages of likelihood. Their advice is, if you suspect, it's probably not a bad idea to have a team approach. You might want to bring in some help, sometimes bringing in an auditor to determine if your books are being up or right. Sometimes if you suspect there's a problem and you can't seem to find it, an auditor sometimes is a good one to hire. And a lot of times they will review records. If you think someone might know in the office or may come to you, that's another way. I mentioned internal controls. That double entry bookkeeping is extremely important because it will help with that. Looking at your the monies that are coming in and going out in your cash flow statements, referring to your bank statements. These are all things that are important. And they mentioned using praise and honesty sometimes to, I guess, encourage people to be forthright if they suspect somebody's doing embezzling. What not to do is, of course, you don't ever want to rush into judgment. That can create a lot of problems with your team, your office. It may be a misunderstanding. You don't ever want to do a group interview. That is not a smart move. You don't want to just corner the employee either. That could be a problem. It could be a legal issue. I think that if you suspect, it's not a bad idea to bring someone in that is not part of your office to assist you with potential, determining whether there is an issue or not. And of course, we don't ever want to step in front of, if you bring in legal advice to, sideswipe them. If you give them that opportunity to come in and help, then you need to give them that ability to do it at that time. You don't sideswipe them. So let's just watch a little bit about embezzlement. Here we go.
Invest your time in the career of tomorrow. Enroll in Simply Learn's.
Only on 7 News, an Aurora man suspected of embezzling more than $500,000 from a medical practice in Denver. 7 News reporter Lance Hernandez always investigating. And Lance, so much money was missing, doctors thought their practice was going under.
Well, Teresa, these documents show that doctors first started noticing their paychecks getting smaller 2 years ago. They were stunned to learn what was apparently happening with their money.
Court documents obtained by 7 News state that this man, Jeffrey Scott Drury, was a trusted employee of the Vascular Institute of the Rockies. He started working there in the 1990s, left to pursue an accounting degree, then came back in 2003. His bosses told investigators that Drury claimed to be a devout Christian and that he and his wife had adopted several children. 2 years ago, physicians at the Institute noticed their paychecks were getting smaller. They asked Drury, the controller, and he always seemed to have an explanation. Last summer, the doctors, worried that their practice was failing, decided to seek an internal audit. They told investigators that just before the audit began, Drury confessed to embezzling somewhere around $350,000 over a 2-year period. He was terminated. The audit showed an actual loss in excess of $500,000. Court documents obtained by 7 News list more than 33 checks written for amounts ranging from $600 for Rockies tickets to $8,300 for a specific Bank of America account. We went to Drury's house. We could hear movement inside, but no answer at the door. Office staff at VIR declined comment, but did verify that this is a picture of the suspect.
Now, we checked and found that Drury only has 3 minor incidents on his record: driving with expired plates and 2 judgments for money owed back in the 1990s. Investigators tell 7 News they expect to wrap this case up.
Okay. So that was a good example. What can happen? So that's about it for this webinar. And if you have any questions, I want you to feel free to please ask, try to answer them.
Thank you, Dr. Hugart. That was an incredibly informative presentation. I learned a lot as well. I do have a couple of questions for you, and hopefully a couple of them are a little bit broad, but one's kind of specific. So hopefully we can look at that. Can you just talk a little bit about your advice as someone in private practice about aging accounts receivable and how that can impact your cash and your profitability, and how even though your profit and loss statement might look good, you could actually run yourself out of business if you're not on top of that?
Oh, I love that question. I don't know who did it, but that's a very good question. And accounts receivable are a bane of a lot of practices' existence. For me, this is where you do have to have a set of protocols, I guess, for your payments of things. You're not a bank, and I guess if you're selling hearing aids or you're providing some type of, you're selling devices of some sort or cost of goods of some sort, you have to have some capability of a certain amount of time that patients are required to pay. Now, for me, I would always request half down and half of the time of the fitting. That was usually how we would do it. Now, with insurances, that's where you can have problems with accounts receivable extending past, I would say, the typical 90 days. And that is, that's always been kind of an issue. We've been very diligent we were very diligent when I was in practice of having a certain person do it, or a warehouse that does the filing for us, to do it in a timely fashion. Because what happens very often is, if insurance isn't done properly the first time around, you're delaying your payment 30 days for every time it's not being properly done. So, when you're in private practice, if you're going to do insurance, number one, you need to make sure that you have a good system in place, that you are filing in a timely manner, and you're ensuring that the claims are done properly. And that will reduce your turnaround system greatly. The second thing is, if you are selling hearing aids, or you're providing hearing aids, you need to make sure that you have patients pay when they leave the office, that they're not extending payments over a period of time. Or you find ways to have things financed. Like, for example, there's Wells Fargo, there's Care Credit. These are great institutions that you can use to help with for the patient to pay, and your cash flow is available. Because that, you're absolutely correct, whoever asked that question. Accounts receivable can be really the bane of your existence if you're not careful. My feeling is 60 days is the longest I would like. But because we used to do insurance, it wasn't unusual to go to 90. If it's beyond 90, you're going to have trouble regaining and recouping that money. The longer you have it out there, the longer it's going to take to get it. So protocols need to be put in place, and your front office needs to be sure to get information. It's all about, exchange and communication, and ensuring that things are being documented properly. Hope that helped.
Thank you. Yes, that was very helpful. The next question is around equipment, and this may vary from practice to practice a little bit, but it's around the idea of equipment and depreciation. Did you have a sort of a best practice that you looked at, where there was a threshold of some sort where you would take a piece of equipment and log it as an asset versus logging it as an expense, whereby the asset would depreciate over time, but the
Well,
expense
I
would be?
usually did. That's a great question too. I would do asset, because typically I'm looking for that depreciation. It helps with your books. It helps it as income, and my accountant always advised me to do that. That's how I've always done it, and at any juncture, if I needed to have a piece of equipment for the purpose of depreciation, I would certainly do it as advisement to, from my accountant, because it was good for my books. So I always used it as the asset, because that was considered a debit.
Yes. Very good. That's good advice. And I think one other piece of advice that I would take away from tonight is, definitely you should have an accountant advising you on some of these things.
Oh yeah, always. Absolutely. You're right.
The next question is really very specific, and it relates to income, cost of goods sold, and then if somebody does a return for credit. So as we're thinking about sort of the transaction for that, they come in, they may buy fitting fees, let's say, they may buy a hearing aid or part of a hearing aid at that time. When you record the cost of goods sold, you're taking that out of income, right, as a negative number out of income. What happens if somebody returns the hearing aid? Does it get booked back to the
Well,
same place it got taken, or
yeah,
how does that work?
well, absolutely. There's usually a section with returns,
Mm-hmm.
for credit, and that is an exchange of what you pay. So you have your expense that you sent out, that you would pay for it, and you have the money that you're sending in. So the patient brings their hearing aid back, you're sending it back for credit. So if you paid for it already, you're going to have the transaction already on the books as being paid. So then you get the credit. So now you're back to debit, right? Because you've balanced it out by returning it. It's already been paid for. You've returned it. So now you have a credit.
Perfect. And you
I don't know
would
if that
take it
makes
out
sense.
of the same place wherever you coded it to begin with.
Oh, absolutely.
Okay.
Absolutely. Well, you know, you're going to have under your chart of your chart of
Yeah.
accounts, you will have it as that. And it may be a section that says your accountant may have a section that says returned, hearing aids returned. And then that's going to automatically go into the transaction area where it needs to go. And that's what he does. That's his whole thing. When you sit down with your accountant, you're going to provide him with things that you're going to be using in your practice under those categories. That category will be charted, and then automatically you won't even have to think about it. Really, you know it's considered under a certain category and it's charted under a certain number, and then it's sent to your balance sheet under your liabilities or whatever your asset.
Perfect.
So that's where the beauty of having a chart of accounts done, you know, with your accountant.
Yes.
So you don't have to think about it.
And that leads me to the final question that I have for you, Dr. Hugart. Do you know where an audiology student might be able to find sort of a template or an example of an audiology practice chart of accounts?
Oh yeah, I've got a couple of them.
Okay.
I do.
Would you be
Do you
willing
want
to
to? Do they want a
share them?
template? Absolutely. Do they want a template or do they want an exam? What I mean, do
I
they
think
want it?
I think a template of how the chart functions, you know, and you have like your balance sheet account codes and then some of the things that are listed there and then income expenses.
So they
'Cause
want like I showed them. Yeah, sure. I
yeah,
can. I can. I
if
can come
you
back
would,
up.
that would
Yeah.
be great. If you
Yeah,
would
I'll
send
help
that
out.
to me, I will be glad to post it for any interested student and then they can sort of see how some of that stuff functions and how it would balance, how they relate to each other. So
I would be very happy to do that. That's
thank
a great request.
thank you very much. All right. Well, at
I
this
have
point, hmm?
Well, I have one more slide.
Oh, good.
Okay,
Great.
I don't know if you knew that. I have one more slide, and I really want to do this in because this is more. This isn't about accounting. It's about our profession. And if you don't mind, this is the last thing. I promise. Um, this week we lost a wonderful colleague to us, and he's the epitome of a leader. And I wanted to honor him tonight. And if you don't know him, I wanted to introduce you to him on several levels, as a leader, as a mentor, as a person that our profession needed, and he was there for us. And he, because of Dr. Hapberg, he has pushed us further along than we would have ever been able to go. And I am bringing him in front of you because your students that are getting ready to go out into the field, and this gentleman was the ultimate leader and mentor, an example of what I'm hoping that our future audiologists will look to. And so I want to remember Dr. Hapberg, and I want you to remember him and look to him as an example of what we need, and his continued work in our field to push us forward. I look to you guys to really grab that light and carry it forward. Um, so that's all I wanted to say tonight. I couldn't help it. I had to because he was such a great guy and wonderful leader, and he's going to be missed. Thank you, everyone, for letting me come and talk tonight. It was a pleasure, and I hope everyone has a great evening.
Thank you, Dr. Hugart. That was lovely, and I really appreciate you saying that. If anyone does have additional questions, please send them to info@audiologist.org. I will make sure that they are forwarded to Dr. Hugart. And as with the other seminars that we've done, if you have friends or colleagues who are unable to attend, please let them know that we will be posting this within the week. And we're very excited about the upcoming conference. If you are seeking a student scholarship for that event, you may also visit audiologist.org. And I hope everyone has a wonderful evening. Thanks again, Dr. Hugart. I really appreciate it.
Thank you, Stephanie. I appreciate you, everybody asking me on here. Thank you.
Good night.
Bye-bye. Good night.
Bye.